Hello, this is Cynthia Fick, and this is the April 15th stock market update. No, today I'm not going to talk about taxes because I'm sure you've already filed or filed an extension. So we'll move on to the stock market. Well, as the last couple of weeks, we've had about a 19% downturn in the market. So it's gone down almost 19%. Then we've had a big increase in the market, a lot of volatility once it looked like tariffs might not be as bad. So there's a lot of that happening. Let's talk about the bigger picture and how I feel like the stock market might be affected going forward. So let me share a chart of the S&P 500 and just look at this today. So this is the downturn we've had. You recall a couple weeks back, I told you we had an inverse flag pattern that we broke down out of, which is very bearish, and the market did proceed to go down about another almost 9%. And so here is that 18.9% downturn from the high. And then again, we bounced because it looks like tariffs might not be as bad. So let's put that into perspective and look at a monthly chart of the S&P 500. So here we have the 19% or so we've had in the market so far. And then if we look back at 2020, we can see we had an almost 35% correction in the S&P 500 in 2020. Happened really fast. And then we had about a 35% correction in the S&P 500 in 2022. It just took a lot longer. So here we are in comparison, 19% down isn't nearly as bad as the 235s we've just experienced, okay? So another thing about this is kind of interesting, is that we went down to about the exact, to the penny level we'd expect for the market to find some support, going back to, this market here in late 2021. So that is a positive. However, I will not be surprised if we don't go back and retest the lows that we've had just a week or so ago, okay, which means coming down to about this level on the S&P 500. And we'll watch and wait and see if that happens and any downturn. So why do I feel, even though we've had a nice bounce, that we may go back and retest? It's not just about the tariffs. It's the damage that's been done technically, looking at all the charts to the stock market. For it to go racing away to the upside wouldn't feel sustainable right now. It's almost like we need to do some more work to solidify our ground, our base in the market. So that's one reason. Another reason is Janet Yellen was on yesterday talking about what she thinks going on in the economy. And she said her biggest concern is not just the tariffs, but the loss of confidence in U.S. economic policy and our financial assets. Usually when you get this, we've had a spike of uncertainty and insecurity about our economic policies to the highest level we've had in 50 years. So the public is very, very concerned. And usually when you have that kind of uncertainty, everybody runs to security. They want the US dollar or they want treasury bonds or both. And that happens internationally, but it's not happening this time. The dollar's down and bonds aren't doing as great either. So something is different about this. I'm not predicting a lot more downside, but I just don't think we're done yet. We'll wait and watch. And if at some point we decide we want to get back in the market, because everything's on sale, we'll do it in a measured approach. We won't go all in and take the chance of further downside. We'll do it over time, called dollar cost averaging. So that is our plan right now. And we will talk to you next week. Hope you have a good one. Bye.